Yeah, so very briefly, I'm really happy to be here in Nairobi. I got so many memories from, I was here first time 10 years ago when I worked for M-Pesa. And I think it's a very interesting time, to make that parallel, because M-Pesa, what it did for the ecosystem is to prove that we can build a valid business case in a context of fragmented continent, difficult business environment, and low purchasing power. And today is a huge business. And what we're doing with First Circle Capital, the fund that I'm running, is we're backing the founders like these today who are reinventing financial services use case by use case for the same context. And yes, we are bullish about the opportunity. However, today the topic is, we have a vibrant ecosystem today, a VC ecosystem, but we are entering a phase of a downturn or a slowdown, whatever you want to call it. And the topic is credit in a downturn. A lot to unfold here. On one side, let's remind ourselves again of the positive business case. Yeah, there is still the growing middle class that is severely underserved by credit. There's a possibility to build a quality loan portfolio if you know how to go about it. Second, rising interest rates, it also means it can become more profitable. We know Nigerian banks in 2022 had a bump growth of 26% of interest rate income. So there is money to be made. However, the negative case is rising inflation, affects and currency volatility in certain markets like Nigeria and Egypt, negatively affects purchasing power and increases the risk of default. On the other hand, we have scarcity of capital. We are entering an era where both equity and debt capital are going to become more scarce. They're going to be deployed at a slower pace. What does that mean for the credit industry? So looking at the two sides, I think I have a wonderful group here of entrepreneurs who are building credit solutions bottom up. I think I would like to start asking everybody what they do, just in short, to present the business in terms of what type of credit, with collateral, no collateral, what's the tenure, and kind of average size of loan in which market, so that we know everybody, what is everybody doing. Maybe start over there and go. Maybe share a microphone, if that one is working.
All right. Hi, everyone. My name is Yemi Olulana. I'm the CEO of Flex Finance. And what we do is we digitize B2B payments in Africa, in particular B2B spend. According to the World Bank, only 25% of that is digitized, and we play in that space to help businesses digitize their B2B spending and unlock more value for these businesses, one of them being credit. And what we do is, based off the data that we have on their spending patterns, so their vendors, in terms of expense tracking, we are able to extend them credit in forms of overdraft and B2B buy now, pay later solutions. And yeah, excited to share more and to learn more from my co-panelists. Thank you.
Hello, everyone. My name is Mejero Emmanuella Kunu. I'm the co-founder and the CEO of Pennee. Pennee is simplifying business finance and cash management for small businesses in Africa. Thank you.
Hi, guys. Good evening. My name is John Egwu. I'm the Chief Operating Officer for Autochek Financial Services. Within the Autochek group, what we do is majorly make it easy and accessible for an African to get access to auto financing, maybe verified vehicles, as well as all the ancillary services within the automotive ecosystem.
Yeah, hi everyone. My name is Shina Arogundade. I'm one of the founders at Lenda. So for us, the idea is to support small business in the supply value chain. That's the retailers who go to the market every day to sell products. Because in truth, a lot of these market people, the retailers, they rarely get access to funding, they rarely get access to credit, which normally, and these guys are the drivers of the economy. So we'll provide them with working capital, with purchase order financing for short term and at a good rate, yeah.
Awesome. And maybe it would be good, just like very briefly, how has your business changed in the last 6 to 9 months in terms of maybe rising demand, availability of debt capital, volatility in the market? Can you tell us what kind of changes you see?
All right, I'll go first. In terms of demand, what we've seen in the market we operate in is, for us, it's gone up by at least 500%. And I think one advantage I would say we have, since we are embedded in the organizations and we have data, NPLs for us is still pretty low. But I think for anyone doing lending in Africa, your work is cut out for you because there's no centralized credit bureau to help you figure things out. You have to figure these things out yourself in terms of how do you properly credit assess. And generally, we are having to innovate for creative ways to access credit at competitive interest rates. Some of which is raising debt from, local capital markets to try and avoid the foreign exchange volatility. That would mean getting a rating. So it has come with its challenges, but we're coming up with creative solutions to try and solve the problem on the continent.
Okay, so to follow up with what he said, I feel like it's pretty much the same for everybody running like a credit business. So we can see like rising interest rates from the debt market, especially as we're sourcing from like local markets to deal with like the forex difference. And so with rising interests, you have to like creatively figure out how to still give a decent interest rate to your customers while also not running at a loss. I think that for us as well, we do have a really, really low NPL, which helps us to have some allowance when it comes to offering prices to customers. But generally, the market is more expensive, it's tougher than it was 6 months ago.
So you see, or actually fintechs, as opposed to banks, see their margins being squeezed as a result because you need to build a loan quality portfolio and grow the market. Right?
Yes, I think so, but I feel like banks are also feeling the pressure because commercial banks themselves are increasing their interest rates. So there has to be like a reason why they are doing that.
Yeah, I think just following up on what my colleagues have all said, but I think we can't look at this in isolation, right? When we look at the problems and obviously the changing ecosystem, you also need to look at the opportunity. I think Africa will have this incredible opportunity of growth. Look at the adult population. Today is roughly 800 million. That really shows there is amazing consumption power in there. Obviously, demand is high. Yes, the credit cycle is in a downturn, interest rates are rising, but I think incredibly you'd see that opportunity for growth. So for us, I think maybe for players on this table, what might be important is how disciplined your underwriting processes are. Like, what are you fundamentally building to sustain this era or this cycle? Because if you are not prudent or you're a bit indisciplined in how you're deploying capital, that obviously would tell in the long run. I think that is what has fundamentally changed, maybe from the view of Autochek Africa, ensuring that we have the right fundamentals in running a proper credit business that can withstand the shock of the period here.
Yeah, I think for me, I like to look at it from the negative and the positive, riding on what John said. I think for the negative, for Nigeria, right, the central bank has increased the monetary policy rate 3 times in the last 4 months. Currently, the CBN is lending to banks at 18.5%. The monetary policy rate is 17.5%, which is quite high, which makes cost of capital across the country very high. And also, I think there's a high rate of inflation that makes it such that, okay, so 2 of the leading FMCGs in Nigeria increased between August and January 2023, they increased their prices of commodities 3 times. So a lot of SMEs are struggling on that end. So, that affects a whole lot of things. But I think for the positive also, we are starting to see more institutions open up to partner with credit institutions, digital lenders, provide us with funds. I think these days people are more willing to listen to us, provide us with the necessary funds, which we're able to lend to these customers and provide for them. Another thing is now the customers are also open. So, they are in a very interesting place. A customer that has, say, 500,000 naira to buy a particular set of products last week, by this week, that money is not able to get that same product. So he or she needs credit to augment what he or she has. And so they are more open to take credit from us here.
And what about availability of that capital? You cannot monetize unless you have a growing pot
debt
of
base, right?
debt that is available for you to lend on.
Yes.
So how do you see the space? Who are your key lenders, and do you see an opportunity to get creative about it, to find new sources or FMCGs or partner with other players?
Okay, so I think for us it's interesting. Like I said earlier, recently we had a local bank in the country give us a credit line that we could lend to SMEs, which was tougher a while ago. We have another bank that recently gave us an offer, and now we have the likes of Bank of Industry in the country also willing to partner with us and provide funding to these SMEs. Then I think on the part of the government, there is more interest. Bank of Industry, the likes of Bank of Industry, even the CBN are looking to partner with or create avenues. Recently, there's a program run by the CBN for fintechs in the lending space, kind of an incubation system. So such are now available. Yeah, but constantly you are looking out, right? Because you are getting a higher capital, your cost of capital is higher. You are looking out for places where you can get cheaper cost of capital. So you are having to look out for probably the likes of AFDB, reach out to them, or other developmental institutions. But at the end of the day, right, you have to reach certain metrics. Yeah, you have to reach certain places before they also listen to you. So you need capital to grow, and you have to grow to get capital. So,
Chicken and egg as usual, no? Like, anybody wants to comment on that capital on your side? How do you guys see it? Any creative things, any secret ways?
Yeah, I think, yeah, you want to go ahead?
Okay, no, I think I just wanted to put it out there. I don't think capital is scarce, right?
Okay.
It's slow in deployment because it's really looking for the right place to be deployed, right? Obviously, the landscape has changed, right? What used to work before obviously doesn't work now. A lot more different parameters are being looked at. So as entities who are helping SMEs, which obviously account maybe 90% of transactions in Africa, we have to become a bit more prudent. Like Shina said, you need capital to grow your business. But the thing is, are you growing a healthy business? And that clearly attracts more capital. So I'm putting it out there that, yeah, capital is available. It's just looking for the right places to be deployed in.
Yeah, I think I agree with you in terms of the abundance of capital. And we just have to properly position ourselves in this market. And what I really wanted to point out is that as lenders, you must have a really long-term strategy in terms of how we intend to acquire capital and build a system where we are building upon our previous successes. So you might start off getting capital at higher rates now, but if you can demonstrate that credibility, be properly rated and have full transparency, that's a lagging indicator for another person to give you interest, to give you capital at a much lower interest rate. And once you continue to build that credibility and you have a long-term strategy, I think you will find out that you playing the patient game will actually pay off, and you'll be able to weather the macro indices and just know that this is going to pass, right? And we are one of the players that are going to ensure that a lot of businesses make it out of this downturn.
And yeah, go ahead.
I think that everything that I would have said has been said. Like, if you're, like, with debt, you have to have, like, a long-term strategy for how you acquire debt. I also think that commercial banks are more willing now, visibly more willing now, to partner with fintech companies to offer credit, to on-lend credit to customers. So there is more of that now. But I think that, like, as he said, as you grow your loan book, as you lend to more people, you sort of build credibility that allows you to access better capital at better rates. And I think that really that's how the market is. It might be harder for someone who is just coming in, but it is definitely moving.
But for the long-term strategy, and we know, the VC world, unfortunately, I mean, everybody wants a 12 months results, and they want to see continuous growth month on month, while when you're in lending business, you're going through different cycles. Your debt cycles are, different than that. And how do you see the VCs reacting? Like, what about equity? To have a long-term strategy like what you're saying, you need to have a long runway. And what we saw with we are an early stage fund. We enter at pre-seed and seed, so we have a couple of embedded finance lending companies in our portfolio who went to market in Q4 to raise next round, Series A, with good numbers, 3 to 5 million ARR. Basically, it sounds like a credit has become a dirty word. We were speaking to some VCs, international ones, that were like, okay, oh no, we don't do credit. Yeah. Oh no, we don't do consumer credit. Oh, BNPL, no, right? I mean, it's unfair, to compare BNPL in Europe, where everybody is indebted, they have a mortgage, they have a car, and now they use that BNPL to buy the sneakers. I mean, of course they're going to default on those sneakers first, right? But in our context, like, we are financing people to buy a fridge, a laptop, and these are the real needs and the assets they want to keep. Yeah. So how do you see, this year and the VCs reacting, and how do you manage this kind of conversation?
Okay, so I think that it's my general knowledge here that a lot of VCs are seeing credit as a dirty word now, like especially international VCs. It's like, I don't invest in credit businesses and all of that. The truth is, I feel like VCs react to the present market at every time, but a credit business that is actually healthy makes a lot of money. So if you have a good and healthy credit business, you have money to play the long-term strategy. And when it comes to growth, there is a right pace to grow when you are doing a credit business. You don't want to grow too fast for the sake of just giving out credit and then having high NPL. You also don't want to grow too slow in a way that you're not capturing as much as you can.
Very good.
Great point. Might I just add there?
Yeah, go ahead.
If you look over the past 10 years, even one of the most successful lending startups have always been priced differently. If you look at their revenue as against their competitors in other verticals of fintech, I think VCs have always priced in terms of valuation. Startups that lend, there are some publicly traded lending startups that are valued at 2x of their revenue right now. These are publicly traded companies, I can't remember in particular. And I just generally think she's right. Like, even when things were rosy, they always price that in. And I think, one thing lending companies can do is there are different metrics, right? It's not necessarily you only track how many loans are given. You could track what's the average return policy, people increasing, for example, the amount they're lending, what is the repeat cycle, what is, there are different metrics you can track to actually show growth to investors. But no matter the climate, VCs are always going to price the fact that you're a lending business in to your valuation and how they assess you generally. So that's my thought.
Okay, I think for me, the way I like to look at this is, even though we are credit companies and we rely more on debt, equity is still the driver, right? Before you can get debt, you still need equity as base, because at the end of the day, for a lot of banks, a lot of debt institutions that will support you, they will still look at your debt to capital ratio. And if your debt to capital ratio is not looking interesting, you are not getting anything, right? And outside that, they are looking at a whole lot of other ratios around your current assets and all, which your equity is able to provide, give you a leeway on that leg. So I think equity is still the driver, even though we can't lend out the equity, right? We still need to use that to augment it. So for us, what we've done on that leg, in terms of hedging, is even when we raise capital, especially when we raise maybe not in Naira, in USD, we hedge it. So we have partner institutions, local institutions, who we give the funds to, and they provide us with Naira. So that gives us ability to acquire more funds to be able to lend. And in a way, it helps us to keep growing. And that's like the fastest way you grow, because at the end of the day, even the funds that you have, even with these banks, you get interest, you get some form of interest on some of these funds, yeah.
Yeah, Selma, just looking at that conversation of a long-term strategy, I think for fintechs, it will always be a journey. Obviously, you start out with equity, and therein with your equity, you're expected to grow and show credible performance. Maybe the mishap would be what sort of structures do you build around that? Because you know, with credit, it grows fast. You often can't control it. It's easy to give out money, it's harder to collect it. So
Yeah.
if you do have that right framework, obviously, standardized underwriting processes, automated decision-making, risk-based pricing, that allows you to use equity to trigger the next level of growth, which is debt. And I think debt is really around maturity, because then it shows that you're really, really ready to handle the next stage. And with that debt coming in, you obviously turbo again, grow more with optimal performance on the structure you've built, and then it gets you access to cheaper capital. And I really think that's the journey every fintech thinking of credit has to go through, and being able to live in that expectation makes that transition maybe easier.
Yeah, absolutely agree. And maybe a little bit on this topic, you know, in this context, then you're growing, you're leveraging equity, you're raising some debt, and you're scaling a portfolio so you can show to the world that it's possible. Here's a quality loan portfolio. We have low NPL. We are utilizing capital very efficiently under underwriting. You know, all the covenants are being respected. But what are some risk management strategies that you see can be deployed? Anything around sharing the risk with merchant partners, sharing with the risk with banks themselves, capital providers, or perhaps repossessions? What are your views on these strategies?
Okay, so I feel like with every partner, some partners are willing to share the risk with you, which can be like a great contract, but sometimes those sort of contracts can come with its own limitations around growth. So some partners are willing to share with you, some partners are going to not share with you and allow you to like fully handle the risk. I think that essentially what really matters is your underwriting process. If you are getting the right people and giving the right people money, it pays off like long term. So if you keep up with that, keeping up with like underwriting credit like the best way you can, so that you are giving the right people money, that's the best strategy forward. Because even if you have commercial partners that are willing to share the risk with you, if you're having a large default, they are going to break the contract and move to someone else. So you really want to have good underwriting process so that you can have a low non-performing ratio. I think I was going to add something else, but it has skipped my mind. So if it comes back, I will say that again.
Yeah, I pretty much agree with you. In terms of risk mitigation, at Flex we view it in two forms. The first one is lending across a value chain. Pick a value chain you understand really well, where you can control a lot of the variables. Unfortunately, the inflation has made certain sectors more high risk than the other. So you need to really understand the macros and pick the value chains you can actually control, and the inputs, the outputs, or the key players. So once you lend, you have certain levels of control in terms of retrievals and etc. And the second one we're really bullish on at Flex is embedded in finance. We believe that will unlock a lot of data and a lot of value in terms of understanding the business more. If you put yourself in a position where you have visibility into the constant cash flow of a business, not just how the money moves, but in terms of the data, how it's categorized, that unlocks certain value. Like for example, at Flex, we are able to advance our businesses to pay their vendors, right? And we do this because we know who they pay, when they pay, why they're paying this vendor. We have access to the invoices. So we're able to give them this credit on a 30 or 60-day cycle. And because we have access to their cash flow, it just makes sense for us to deduct that money on the due date. So that's how we are approaching in terms of risk mitigation. Thanks.
Very good.
Yeah, also joining my colleagues, I think we also have to dissuade or stop this concept of looking at credit from a bystander perspective. You need to look at it extensively. At Autochek Financial Services, our focus is to build pillars of excellence in the full framework, right? Think about origination, think about fulfillment, think about collections, recovery and disposal, because that's really where you control the real ecosystem, and that's where you can mitigate your risk. But if you're looking at credit from, I just want to operate in one sector of it, that could be a big problem, right? So I would advise, right, really looking at all the fundamentals and really going in to ensure that each of those pillars, you do have some sort of pillar of excellence in your operations.
Very good. And what do you think about repossessions?
Good. Yeah, so I think repossession is a very funny concept.
It's hard. It's controversial,
hard.
huh? Like,
Yeah, it's controversial, it's hard, but also I think there are quite a lot of things you can utilize to your strengths, right? We are in a fintech conference. Obviously, there are quite a lot of innovative ideas that are all over the place. IoT tracking, ensuring that these assets can be tracked where they are. But it also depends on the sector you're playing, right? Because if you're lending on a mobile phone, obviously it becomes a bit more hectic to track, right? But in our case, we play more in the automotive space, so it's almost impossible to move this asset. Yes, you can attempt to decouple a vehicle, but applying that aspect of technology to help your business operations, right, with regards to recovery. And then you leverage on what the law states out there, because if you are operating in Africa, there are quite different legal jurisdictions that you have to deal with. But playing with the law, right, and ensuring that you do things the right way and not the wrong way, that, for me, cleans up the problem around repossessions.
Also, to add to repossession, I feel like you mentioned, the sector you operate in matters. So, for instance, for Autochek that is giving out car loans, they're literally giving out cars. But if you're financing inventory or things like that, you can't really repossess those inventory. And if you want people to like give like collateral, say their cars or things like that, you can't really. So the sale of it. So if I have to retrieve someone's car and then try to sell it, the market might not be as easy as they just paying back my money. So I would still go back to saying that
absolutely,
the first
in your
way
space, absolutely,
the best way to think about getting your money back is underwriting rather than thinking about what you would do when the money is lost.
And anything to add? Anything
Okay,
on your
so
risk
I think there are a number of risks in lending. Lending is risk, yeah. Constantly you manage it, right? First, there's a key man risk. The person you are lending to, is he of good character? Is he the right person? What are people around him saying about him or her? Yeah, basically, right. That's for us because we lend to businesses. Then one of the ways we've tried to mitigate it is to lend through aggregators, associations, and today we are having credit life insurance embedded in our pricing. Then you have diversion risk. Customers, you lend to them for something, they move the money to another thing.
But how many customers qualify for an insurance product of such sort?
Sorry?
What percentage of customers would qualify for an insurance product of that sort?
For us, all our loans have credit life insurance today, yeah. Then you have the diversion risk you mitigate. Today, how we do that is for some of the SMEs, we pay directly to the suppliers to give them the product, or we get you the product. That way, what we finance is what we take. What we finance is our collateral, right? So we try to have that at the back of our minds. Then we have counterparty risk, rather. So I finance a purchase order or an invoice, and So today, I think how we've done about that, especially with the situation of things, is we only lend for contracts from investment-grade companies. If you have a company that we are not scared of the going concern, right? So these are some of the things we kind of just do today to give us some. But currently, we are also looking out for guarantees. Yeah, we understand SMEs are small, they are struggling, so we are looking out for guarantees that can help us lend, be more open to lending to even customers that, that should get, but we are not so comfortable with them. We are not sure of their repayment. Yeah, so we are also looking out for that.
Very good. I'm conscious of time. I would like to offer any questions. Otherwise, I have a closing question, but opening to the audience. Anybody wants to pose a question to our founders here? I have a question.
Go ahead.
Strategy for survival in 2023.
Dum, dum, dum.
Sorry, I didn't get that.
What is your strategy for survival in 2023?
Oh, okay. Should I go first?
Founder wisdom.
Yeah. I think the first thing to consider is like, this too shall pass. That's the first thing. So always have a long-term view, of the market. And I think one thing that we can also do in terms of what we are doing at Flex to Survive is we are making our KPIs reflect the times that we're in. Okay, what exactly should we be tracking now? What are the health indicators where we're not tracking before that we need to track now? And we are assessing a lot of the industries that we actually learn to and we operate in to ensure that our strategy, our lending strategy is reflective of the current macroeconomic factors. Yeah.
Very good.
So I think that for us, it is really that this too shall pass. Like economic cycles happen, and so in a booming economy, credit enjoys the most. Credit is still like the most way you can make money when it comes to finance. So I think that it's just really about staying healthy, growing at a healthy pace, and then coming out from this alive.
Yeah, so fundamentally, strategy for survival is, because obviously you don't want to also raise the bar too high where people can access the stimulant for growth. So for us is some sort of adopting a risk-based pricing where the more risky customers obviously get that priced into their facilities, and credible people still can access what they need. That's our view to survival in 2023, and obviously being a bit more automated in how you look at credit, because we do have quite a lot of ample data that can improve our credit making decisions, and that's how we look at 2023.
Yeah, I think for me, I could go on and on about strategy, but I think the paramount one is don't run out of money. Whatever you do, don't run out of money. As long as you're fine on that leg, then you'll be very fine, yeah.
And we have a question from the audience.
So I think this question is really just to the panel in general. So someone mentioned, I think at the beginning of the conversation, around the lack of credit bureau access. So with your experience, what have you found to be sort of like the most effective alternative data sources to be able to access customers in terms of your underwriting process, considering limitations with credit bureau access?
Okay, so I'll take that first. The credit bureau, for instance, if you're in Nigeria, I don't really know about credit bureaus outside Nigeria, but if you're in Nigeria, there are credit bureaus that exist, and while they might not be perfect, they have data that you can use. So that can be like a level one base where how you for how you do your underwriting, but also having insight into the real transactions that is being made, like not taking income as the only base of how you make decisions for credits, looking at things like what sort of transactions are happening for this business or for this person, and what can they afford in liability, what is their real cost, like how can they afford like a 20,000 naira payment every month, can they afford 40,000 naira payment? So those are the sort of data that you really want to look at before offering anybody credit.
Okay, so I'm not sure I'm not sure the person said there's no credit bureau. I don't know, but at least I know 3 credit bureaus in Nigeria, and we are integrated with 2. We use them currently to check and confirm, right? Then in terms of KYC, generally, we check credit bureaus. We check for other KYCs. We have integrations with another company that helps us verify ID cards, BVN, any ID card you have, including NEPA bills, and even check out for fraud or if the customer is watch listed. So you are able to integrate, you are able to use this to make some of your initial decisions to lend to a customer.
Sorry, please let me add something. So when you're looking, so in looking at the transactions, I had mentioned that you want to look at the cost. You also want to look at the characteristic of the type of transactions they are doing. So if you're doing consumer lending, for instance, you want to look at key things like betting, right? So if someone is a chronic gambler, they're probably going to take money from you and gamble with it. So you want to look at some of those key points. For instance, one of the data we measure, because we give businesses money, is like how long does it take for 90% of money that comes in? How long does it take for it to get out of the business? So you want to take like alternative data that really matters in the financial operations of the business and use that as a way to underwrite your credit.
Yeah, if I might add to what they said, the credit bureau do exist, but truth be told, lenders in this market have to do more work than they would do in other additional markets. And what we've seen to work for us is beyond looking at that business in particular, we look at the entire industry in which that business operates. What are the macro and micro factors, for example? What are the key performance indicators? What are the key levers of that industry? What pricing could go up and could ruin this business forever, for example? So we like to keep a tab on all these things. Our team spends a lot of time. So I think because for the longest time, lenders have prided themselves in being able to give loans really quickly. And because of that, a lot of steps have been skipped. So what we try to do is take our time to understand that industry which you're operating. Then, once we've developed an expertise on a model that works, then we go to another industry. So we analyze the industry, then the business themselves, which is why we like to look at the value chains, and we believe so much in embedded finance.
Yeah, I think responding to the question, it's in the context of Africa, it's a real problem, right? Because maybe Nigeria today enjoys the benefit of credit bureau. Other countries don't have that luxury.
And it's a fragmented landscape.
It's
nobody
very
has a full
fragmented.
picture.
Yeah.
True. So if you operate in that scope, like Autochek does, currently functional in 9 markets, and across these markets there are multiple operations of credit, as you might put it. In these situations, you now have to rely on alternative data sources, right? Obviously, like my colleagues have said, maybe look at the few metrics on the banking statement, but much more than that, there are other sources that could tell you a lot about the person. Social media interactions, mobile statements, how they interact on their phones and all that. So it moves away from just looking at the credit bureau and then becoming a bit more invested in alternate data sources. And I think that's where data plays a vital role.
Very interesting. There is another question from the audience. Let's take it. Yeah.
Yeah, thank you so much. My name is Amos Mwangi. I'm the CEO at Partners Africa. We lead to affordable private schools here in Kenya. I'm interested to know from the panelists who spoke about leading to ecosystems, B2B model, how you mitigate against diversion risk. For instance, if you are financing motor vehicles or whatever you're financing, how do you confirm that the money has been utilized for the purpose that you're financing?
Okay, so for instance, we do B2B and we don't give cash to businesses. So we aggregate vendors and we allow people to be able to pay directly to their vendors. So it looks like a buy now, pay later model in a certain way. So if you are going to, because early on when we started, we did used to give cash and we noticed that some of these monies were being diverted. So by doing this, if you are going to get a certain item, you have to get from like an existing vendor or introduce us to your vendor who we like onboard and KYB as well and ensure that the money is going into what you want to get. So some of the benefits of that is that we've seen instances where a fashion business, for instance, is trying to get something that only a baker will need. And so we're able to flag that sort of transaction and find out why do you need an oven when you are when you have a fashion business, for instance. So those are some of the ways that's one of like the most efficient way that I know that you can use to mitigate against diversion. I also know there are things like invoice financing, where the invoice has to be provided and then you can finance the invoice directly. So those are some of the things that you can look at.
I think just to add, can I go ahead?
Yeah, go ahead.
I agree with her. That's why I believe with the point of embedded finance. At Flex, for example, we know all your vendors. You've been paying them. Let's say, for example, you have a diesel supplier, which you've been paying a fixed amount to. Because we have the history of that data which you've been paying, if you need to advance to pay that vendor, and for example, if it's more than the average amount you're paying, we obviously know that some collision has happened and we need to look deeper into it. So As lenders, we need to go deeper into the trenches to understand this business's pattern and build good data models. Yeah.
Yeah, so I think she kind of said a lot. So there are infrastructures today that makes lending, like, it's not perfect, right? But it's getting better. Today you have platforms that are able to help you automatically spool customers' bank statements across all banks, basically. I'm sure, initially we were even using a company here in Kenya, and they had a presence in Nigeria before we started using a Nigerian company. So it gets better. So with these, you're able to see customers' history. You're able to see who they've been paying to, what they've been doing with their money, and it's seamless. They don't have to go and falsify a statement and bring to you. You automatically spool it using their data. So this way, you're able to avoid diversion, like I said. You know who this customer has been paying to. You know the vendors they've been working with. In a case where they are trying it on, or they're saying they want to do a new transaction, you try to verify who the vendors are, and you do your own know your business KYB, or know your customer's customer in this case, and then if it tallies, you can disburse, and if it's not, you decline the request or tell them to use another vendor, basically.
Yeah, I think to tie up what everyone has said, I think it goes back to your credit policies, right? Because if you have the right credit policies, it does put everything in check where source of disbursement ties in and you can verify who you are paying to. I think it's always safer to pay to the originating invoice as against cash disbursement to the customer's account. If you need to disburse to the customer's account, I think there are solutions out there that can pick the money immediately as soon as you disburse, so that you don't have those situations around diversion. But it goes back to your credit policy.
Very good, thanks. One more question?
Yeah.
Okay, one more. And then drinks are waiting. I think
Okay,
we're majorly overrunning. I didn't expect credit to be so popular.
Yeah.
I love it, but...
Sorry about that. Yeah, real quick, and this question is to you, who you actually do the VC part. So if you have a situation, so I know they're micro lenders, so you'd actually lend to them. So what if you get into a situation like Kenya did, where they came back and looked at the CRB and scrapped out all the defaulters, and then they still owe you the promise that you had actually created, right? So you're the lender, and so what happens when regulation, so like a new government comes in and changes a policy? What do you do when you've actually lent? And so it wasn't the business, but it was actually a policy that they could not control.
So actually, I think the change in regulation was a somewhat positive one from our point of view. We think that we need increased transparency in the sector. We welcomed it absolutely. We want the lenders to be responsible. We want the data to become transparent. We want to create, it's in everybody's interest to share the bad lenders and to enrich the credit bureau's quality of information. So in our case, we invest in credit businesses, yes, but we prefer embedded models. In this way, we see that cost of acquisition is lower, and also there is an additional data source that can be leveraged. Also, the social contract is in some cases reinforced, and it helps build a quality loan portfolio. But also from the VC perspective, we see that credit businesses, obviously the opportunity is huge, but it's very hard to grow this business. We see that the scalability and the multiples, it requires more patient capital, right? So the question is really, in today's context, is this, the most sexy VC opportunity? Perhaps there is another source of capital that should be entering this space. Perhaps more development finance organizations should be entering into credit fintech, taking that risk and building it out. Perhaps it's more on small cap private equity funds. There is a debate around this model being attractive enough for VCs.
I agree.
Well, that's all. Well, thanks everybody. This was great. Excellent group of founders. Yeah. It's time for drinks, no?
Yeah, I guess so. Yeah, time for happy hour. But before that, let's appreciate them once again for all the good sentiments that they've given us on the credit market right now. Thank you so much for all those insights. We truly hope that everyone found value in the conversations that are being affronted here and the questions and, of course, engaging with our panelists. Remember to pick a contact or two and network as much as you can. Welcome to Africa Tech Summit 2023. I guess it's a good place to end it. We're going to have a photo session. Please go ahead. And then we will just disperse for the happy hour. My name is Brian Jojotieno. You can find me on NTV Kenya. Let's do this again tomorrow. Thank you. Have a good evening.